Hello and welcome to Nirmal. I am Piyush Jain, and today we are bringing to you our conversation with market gurus. Now, budget has already passed. It has been some days. We have seen a lot of activity in the market. It has been a budget which has been universally appreciated by institutions, corporates, market experts, economists. Let's try and understand today from somebody who is a market veteran, doesn't need any introduction, and also basically has an expert view on almost every sector. Let me now welcome Mr. Sunil Subramaniam, MD and CEO of Sundaram Mutual Fund. Sunil
Thank
sir,
you.
welcome.
Thank you.
Let's talk about the budget here. Now, what's your view on the budget? Looks like there are a couple of firsts. Highest ever capital outlay, looks like a very strong investment focus. We also saw again fiscal deficit targets being met from last year, which was a sort of tumultuous year for the bonds. This year again, there has been a sort of global rally in the bonds. And we also saw the government really trying to put money into a couple of very specialized sectors: agriculture, defense, manufacturing, a bit of logistics. So, what do you make out of the overall budget theme for the market and for the economy?
So I think that two things about the budget. One is, I think it's a brilliantly balanced budget, right? Because you try to keep multiple stakeholders happy and keep the balance. I think that's been a wonderful job. The second aspect I like about the budget is it's conservative in its assumptions and has left enough cushion for things either going wrong or going right to expand. So I would start off by saying, for example, that projecting a nominal GDP growth rate of 10.5% is extremely conservative. Because if you assume 5% on an average inflation, you're talking about 5.5% GDP growth, which actually factors in a possible correction due to a strong recession in advanced countries. So she's taken care of that aspect. The second is the taxation related growth. Also, if your GST is about 12% and personal and corporate incomes are exactly at nominal GDP, right? So that, and the fact of the matter is they've kept revenue expenditure absolutely flat year on year and actually reduced allocation to Narega and such stuff which went up during COVID. So if you see there, that though it is supposed to be an election budget, they've eschewed all the election-related giveaways, but at the same time made sure that employment generation, whether it's through rural capex, whether it's through the Skill India program, they have given a lot of boost to employment because they hope that over the next 12-15 months, private sector comes out, makes these announcements about these big jobs, and that would help the country. So I think that keeping the elections in mind, but not going overboard on revenue has been a great taking away from temptation. Because let's bear in mind, who's the main audience of the budget? The main audience of the budget is the rating agencies. Because India is a capital-starved nation. So we can't afford to hurt foreign capital coming in. So keeping that in mind, she has avoided playing to the gallery, but talked to the right stakeholders. So I think I would say that in the circumstances, that's been a very brilliant job.
And that brings me to a sort of interesting question here. Nominal GDP growth rate, you just alluded to the fact it was conservative. And when I look at the budget, and I just sort of do naive calculations here, such as strong investments going to infrastructure, very large population, we now actually are equal to the Chinese population, young population. From that aspect, what would be your own sort of nominal GDP calculations? Like, where are we positioned?
I think that, inflation itself, I expect to settle around the 5.5% level for this year. Okay. And so if you're at 5.5%, and I think that at the worst case, we should be at a 6% GDP. So you're clearly talking about 11.5 to 12 as a band for nominal GDP. So which gives clearly at least a percent and a half headroom over and above that. And I would expect the stock market to then reflect those kind of numbers in terms of the, returns to the investors.
Right. And from that aspect, does this budget actually is providing enough levers to really lift the earnings growth? Where are we in the earnings growth cycle right now?
So I think that one of the key things here is that if you see the infrastructure is a multiplier effect, right? And the infrastructure doesn't just come from, there are 2-3 things here, right? So one is the government capex, that is central government. The second is the government is also provided for the state governments a 50-year interest-free loan, but provided they spend it in this year. So can you see they are nudging the state government to actually go and spend that money so that the trickle-down effect comes down to the economy. That's the second part. The third part is that, see, this whole infrastructure, people, while in itself, it's a good thing, right? Because it creates jobs, it creates multiple effects. But the key thing is that for the PLI program to succeed, infrastructure is key, because one of the key things is India has such a strong labor advantage, both labor cost, labor supply, as well as on the skill side. We still actually Make in India didn't succeed because our infrastructure, the ease of doing business was not so great. So I think that what this was doing through infrastructure is to make the PLI program a success, and that is where the multiplier effect will come in. So I think that while today may not be conducive to increase exports because the world is in a slowdown, but if you give yourself 12 to 18 months to build all the infrastructure and build all the factories in PLI, I think 3 years from now, you're brilliantly positioned to actually activate this China Plus One as a real growth engine of our economy.
Interesting thought here. And if I go towards the other side here, now I'm picking up our expectation around 12% nominal GDP growth rates. We actually have seen that a lot of schemes has been sort of planned for the agriculture sector. And this time, what I really liked was that you're not talking about really giving out the money. You're talking about building cold storages. You're talking about building up warehouses very intelligently, because some states already have it, some states they don't have it. So investing into the sort of agriculture sector, and then also through some other ways, sort of giving out money to the middle class. What does this entire thing actually means? Because again, a lot of rural population contributes to consumption.
Absolutely, and I think that that's where the income tax, nudging the people towards a new regime, where if everybody adopts the new regime, you put 35,000 crores of money on the table, right, as a giveaway of income. And so I think that increasingly the younger youth population would opt for the new scheme. The existing ones who already bought a house and getting 80C from the thing may take time to shift. But a new guy starting off, and India is getting younger by the day, they will straight away opt for the new regime. And I think that the lesser taxation means that the money can be gone on and spent. And you are right to say that putting money in the hands of rural people by way of job creation through infrastructure related effect has a far more lasting effect. So I think that consumption should get a boost. And I think consumer durables, right, which is the upscaling automobile sector, and I think the continuation of the Aadhaar housing with 70,000 crores of allocation. As you know, construction and real estate is the next big employer in the country, right? So I think that the focus has been underlying on employment without overstating it. At every place, if you see, it's the employment generation. Because I think that from an election perspective, inflation and employment will be the two key features. And so even on inflation, if you notice, they have done this FCI outlets into far more smaller places. Because I think managing supply of food grains at the closer to the election to make sure that there's no shortage and a spike in inflation. It's also another key theme which, they've done it in the past. The previous election, they did the same thing. On inflation, they ran a program called the TOP program. And the top is nothing but tomato, onion, potato. Is these three prices they need to control. So all this, the agricultural activity is also oriented towards controlling inflation closer to the election and generating employment. So I think that's why they've been very smart about this.
And experience always makes a person smarter. They've learned. Okay, so now building, and I wanted to ask you this, and you have already actually initiated the conversation here. When I look at the budget, we talk about consumption, like how the money is going into the hands of the people. And then I start thinking about it. Which sector is actually going to run, or which sector is going to get sort of more earnings here? Consumer staples, consumer discretionary, consumer durables, like where in the entire consumption basket, including auto, we call them as a discretionary consumption. Where in the entire consumption basket, how sort of from an institutional point of view, you would be actually strategizing?
Actually, for me, discretionary consumption is the way to go. And in discretionary, I would include consumer durables, include auto, as you said, and I would include housing and real estate in that. So it's these three which I feel that in a scenario where banks are flush with money, so all consumer discretionary items are generally done on borrowed money, whether it's a zero cost EMI or it's a regular EMI. So banking system is flush, ready to support the thing. Per capita income, if you see India's per capita income is among the fastest rising as a proportion of the world per capita income. Putting money in the hands of rural people, and now in the rural also the credit culture is creeping up. If you notice, they've also earmarked 20 lakh crore for agriculture related lending for the banks. So putting money in the hands of the people. So I think the multiplier effect of not going and put, see, historically the rural person, right? If you look at a farmer, he would take the harvest money and go and buy a motorcycle or buy a
Yes.
car. But now that's changing to say, I'll save that money and I'll take a loan to buy it. So I think the credit culture, right, is changing. And I think that's where the multiplier effect will come. So to me, banking and financial services and para banking, which is the NBFC space, because they have the last mile reach, is probably going to be the key. Because not only are they going to benefit from a higher savings rate as the per capita income goes up, they are going to be lending not just retail but corporate. Infrastructure lending is also going to be supported by the banking system. So to me, actually, a more sustainable thing is the whole banking and financial services space, closely followed by discretionary consumption. Capital goods and infrastructure, you got to wait a bit because typically the infrastructure is a cyclical thing, right? So what happens is that first the order book comes. Based on order book, prices go up. So valuation go up, but earnings follow. So there will be a
Right.
period of time when the infra stocks, the cap code, the building materials will look expensive because the earnings are not yet shown. But the market is discounting the order book. So you have to have patience to see that order book, and very often that order book execution actually results in far greater EPS growth than market anticipates. So I think that there it's like a patient bird, wins the race, right? So in infra and capital goods, I would say wait for 3 to 5 years for it to play out. Today's valuations look expensive, but be patient and it will pay rewards. Don't get panicky by that.
Very important message for our viewers. But between the infrastructure, how actually we should be playing out the suppliers, the cement, and all the ancillary players, or you would believe the sort of the road and the heavy companies, or the EPC players? Like there are so many ways to play it.
So I would say EPC and building materials. These are the two key because, like I said, the PLI, the roads, everything will need that EPC contractor and the building materials to be supplied. So the first leg of the rally will be in these, and the second leg will be going into the actual infrastructure, like the roads and the power projects and all of that. So I would say yes, play the cap goods cycle first, and then play the infra cycle.
Right. Now, I was also taking a look at your the last year fund, just as an example. About 40% exposure to the financial sector. You alluded just now in your conversation, and I wanted to build on it. About 30% to the banks, around 5-6% to the NBFCs, another 5-6% to the housing finance. I won't go into stocks because I know you won't be talking about stocks.
Correct.
Now, within this 40%, uh, how actually you would like to play between the flavor here? Would you like to go slightly more overboard on housing finance, or this is something you want to maintain as a flavor?
No, I would largely look for larger private sector banks which are incrementally focused towards corporate lending.
Okay, corporate
To
lending.
me, so see, retail lending has already been there. I think the good quality NBFCs and the retail private banks have been playing that story. So it is a discounted story. But I think the corporate lending is going to be the new leg, right? And what happens, these are big ticket loans. So the cost needed to give a loan and service it and track it is far less than in retail where you're dealing with large number of accounts and all of that. So I believe that given the fact that capex cycle in India for the last 10 years has shown only a 1% growth, right? There's a pent up demand which will execute, and then banks, would tend to take larger ticket exposures there. And in a situation where demand for loans is rising, you're already seeing 17% plus credit growth rising, the pricing power will be the banks. So I see net interest margins, you're already seeing that RBI rate hikes have been passed on only to the extent of 35 to 40 bips. But lending rates have gone up by 100 to 150 bips. So I
Always.
think that so that I think is the key. I think a good quality corporate lender, whether it's private sector or public sector, who should have the good systems to choose the good projects, lend there, have the balance sheet strength to lend, have the necessary credit appraisal skills so that you don't end up with an NPA. So I think that is a skill set which is inherent in certain banks because of their parentage, because of their nature. Like I said, I can't take stock specific names, but you can figure out what I'm talking about.
Absolutely. Your fund itself is telling that you actually like the sort of larger banks, and that is pretty much evident here. And from that aspect, housing finance also same story. The larger players who are well spread out are able to manage the sort of risk. Same story in that sector also.
Absolutely, because the larger players have another advantage that they take on large book sizes and then they sell it down. So they're able to risk manage their portfolio much better because they cure the portfolio and then they push it on to the debt capital markets, right? And so they're able to leverage on that, keep their small spread, but keep the book. So by just using, let's say you've got 1,000 crores to lend, they actually create a multiplier effect of 5 to 6,000 crores by selling down the book. The originate book distribute model, right? Right? They take on the loan, book it on their books, and then sell it down and get finer rates from the market for a good quality portfolio, which they do after curing. Let's say you have 12 months or 24 months of people who are repaid on time. Then take that quality of the portfolio, leverage. So this model means it's a multiplier effect. The banks can raise far greater capital and service a far greater set. And I think housing finance is brilliantly positioned there because COVID has done a big shift. One is other housing, which the government is promoting for the small type houses. But COVID has also done is upscaling of houses into the hinterland of the cities, right? So just outside, like a Kharghar in Bombay, right? So there people want to move from their 1 BHK to a 3 BHK because that, I think, upscaling which is happening is a huge thing. And so you see, despite EMIs going up with the rate hikes, demand for housing is not cooling off. And what has again benefited there is that rentals are also going up. So the cost of ownership, when you, even if you're not buying your house you're staying in, if you're going to rent it out, today at about 3% differential between the EMI that you pay and the rental cash flows post-tax that you get, is just a 3% differential on your individual balance sheet. If you commit 3% cash flow from your salary, you can buy a second house. So that then expands the people looking at this as an asset class. So I think, yes, housing finance, but like I said, managing the portfolio well, getting the risk done properly, which segments do you lend to, those are key factors. And I would tend to back the risk management skills of the larger companies any day on this matter.
I think this answer particularly should be a great sort of education, I think, for our viewers if actually they are really looking at housing finance. I think a sort of great answer. Want to sort of ask you, before I go to any other sector, I wanted to ask you your views from the perspective of bond market. Ideally, last year we have seen underperformance. This year, when we are expecting that the global interest rate hike cycle should end sometime, maybe 1 quarter, 2 quarters, 3 quarters. For Indian markets, as a sort of institution, what is your own expectation? Equities will take their own power, continue the momentum, or this time you're going to see some sort of very strong bond outperformance versus equities? Like for a viewer who would be very a naive viewer, what this sort of entire complex arithmetic means?
So I think first, when you're in answering about the bond market, I need to answer the equity market question for this year. And I see this as a year of two halves. I see a first half of great volatility, and I see a second half of a strong bounce back, right? So from an equities perspective, the first half is a good time to accumulate, and the second half will deliver the returns. But because of the first half volatility, I would expect only high single-digit returns to accrue from the equity portfolio. So then from a one-year perspective, you look at it, the bond markets will also deliver a high single-digit return. So you will tend to look at and say, both are giving the same return. I have less risk in bonds, so why don't I relocate to bonds more? But I would caution against that because though the budget was expected to tinker around, it didn't happen. So there's a 3-year taxation rule around the bonds, where there's still a 1-year taxation on equity. So I would argue that year 2 and year 3 of equity would deliver strong double-digit returns. Hence, if you now invest with a 3-year outlook, you would still make 50% more returns than you would do from a 3-year bond investment. So to people who are saying, oh, should I switch to equity to bond this year? I would say bear in mind that you'll pay short-term capital gains tax when you shift at the end of a year. So now coming to then who should invest in bonds? It's a good yield. A typical fixed deposit investor can look at bonds today and he should split his portfolio 2 ways. So one is that I don't expect India to go through the dramatic downturn in interest rates that the US is going to go through next year. See, after peaking at 5.1 and being stable for the rest of the year, I expect 2024 onwards US interest rates to come down. But India We never went up that much for us to come down that much. So we'll be stable. So maybe a percentage this way, that way is what our interest rate. So to a typical debt market FD investor, the bond market represents a good investment from two perspectives. One is if you want to lock in for 3 years plus and you don't need that money, target maturity funds give you that committed yield. So target maturity are just like fixed deposits, but with a advantage of taxation. So somebody who says 3 साल के लिए मेरे को पैसा नहीं चाहिए, instead of putting in an FD, I would say put it, because you will get about 50 basis points more on a gross yield, but definitely 150 basis points on a net yield post-tax. The second type of investor is the person who is comfortable with the bond market's interest rate cycles. Then I would say that you put your money into a medium-term bond, because I see interest rates peaking after tomorrow. I expect RBI to rate hikes again, but probably the last rate hike. And then I expect a period of stability and maybe a slight decline. So if you're holding for a 3, 4, 5-year period, capital gains will accrue from your mark-to-market portfolio, because I don't expect interest rates to go much higher, but trend lower over a 3 to 5-year period. So somebody who's knowledgeable about the bond market, they can start taking a bet on the medium-term bond, where the mark-to-market gain also come into play. But definitely, I don't think this is the time for an equity investor to shift to bond, just because this year you're going to see comparable returns between equities and bonds.
Right. And now let's talk about something which we were actually discussing earlier, and which is we have seen the budget, the entire sort of a noise around it, which sectors you've discussed. Now the question comes is manufacturing, something which everybody has been talking, but there is also a very important component of the economy, which is the service economy. And we know again it contributes a lot, in India case, a lot to the employment, and also from the perspective tax generation. So from the service sector, which sort of sub themes you like, and also basically, as I know, you also have a dedicated fund for that. So help us understand on that.
So basically, the theme around the fund is like this, right? That Indian economy, I think about 54-55% of the economic GDP is contributed from the services sector, right? But only about 40% is reflected in the capital markets. Why this gap? Because a large part of the service sector is in the non-formal sector. A large part is the old economy sector. As we know, over the last few years, thanks to the JAM Trinity, right, Chandan, Aadhaar, Mobile, and the whole GST digitization, formalization process, you're getting more and more people into the. You saw that EPFO, things have doubled this year, means more people are getting into the formal sector. Now, as they get into the formal sector, right, naturally the stock market will also reflect that. So I think that while the service sector proportion to GDP, so it's agriculture, manufacturing, and services which play around with the GDP, right? So even if the service sector goes from 54 to 52, because manufacturing is going to go a bit higher, you will find that the stock market is going to show this 40 heading towards the 50. So I would say from a stock market perspective, the manufacturing cycle, while it lead to it, your services is where your capital wealth creation will happen, number one. Number two, just because manufacturing doesn't does well, doesn't mean services doesn't do well. In fact, for every manufacturing job, 1.8 jobs are created in the service sector, either through delivery agents, through car drivers, taxis, through canteens, through QSR. So this growth of manufacturing will be accompanied, and as you said, the employment generation is far higher, and so government support for services sector also will be coming through. Now, within the services, it's a wide gamut. There are 14 to 15 subsectors. So we consider logistics also as a part of services sector. We consider retail as a part of services sector. Of course, banks and financial services and IT services will also be there. So airlines, aviation, hotels. So it's a very vast sector, and you can already see hotel rates are going through a V-shaped curve. Airline rates are going through a V-shaped curve. So the economic activity gets naturally reflected in the services segment. And I think our services fund, being very unique, one of its kind, and it's a multi-cap fund. Today, if you see as of last month, it had about 50-odd% in large cap, about 20-odd% in mid cap, and 20-odd% in small cap. So it's a true flexi cap fund. Why I say this is, initially when the capital market gets these companies, they all come into the small and mid cap. Then over a period of time is when they become large cap. So you need a close focus on the small and mid cap segment to play in the services fund. And I think that second thing is that it also has an export orientation through IT, but it also a domestic orientation through logistics and retail. So I think that the blend of outward looking with inward looking this fund is well positioned to do, and it's been doing well. It's among the best performing funds in the flexi cap category. So I would argue that while a lot of attention is turning towards manufacturing because it hasn't done well and it's the way forward, do not ignore the services, because the capital market wealth creation potential is probably equal, if not better, for companies in the services sector.
Absolutely. So that is something I think which our viewers again will take note of. Just building on it on technology tech sector, which has been the favorite I think of for many years. Last year was slightly tough. How do you see the prospect this time for technology sector this year?
See, actually, I see the EPS growth and the actual business potential for IT sector as decent, right? But I'll tell you where in the stock market the problem happened is that, see, it was went through high growth rates right from the 90s to the 2000s. But over a period of time, since that high growth was expected by the market, right? For the market, the high growth expectation meant it became a safety sector pre-COVID. In COVID, what happened? Suddenly there was this light, nirvana kind of a moment where everybody said that all companies, work from home, Internet of Things, artificial intelligence. So suddenly it became like another Y2K moment for IT, and the valuation shot up. So the earnings did not go up significantly, but the valuation shot up. Then the recession came on. The Russia-Ukraine war was unexpected, and then the recession expectation came out. That bubble of high valuation got burst. And last year problem was not so much an earnings growth problem as much as a valuation correction problem. Now this year, is that valuation correction done or not? The key is that when India goes through a bit of a crisis, like what happened with the recent group of companies where the
Yeah.
news report came out. At that time, FIs like India, but they tend to prefer safety. So IT suddenly got buying because that certainty welcomed them. So you saw the valuations again start to creep up. Now, going forward for this year, like I said, the business model for IT is robust and the earnings stream will continue. What price the market is willing to pay for it is a function of the recession. If you're going to go through a soft recession, right, which is the latest indicator, then IT will get that valuation. But if you're going to go through a hard recession, then there'll be a fear that IT's numbers may come down. So I think, again, we need to track the recession and the interest rate hike cycle in the US to take a call on the current valuations. Are they worth investing as a growth sector or as a safety sector? Because IT should be in your part of a portfolio. What component it is, safety component or growth component, I think the coming days, the recession will help us decide.
My last two very short questions. What will be your top two sector picks if you wanted to actually pick for this year?
For this particular year, right, I would actually, given the volatility of the first half and then a bounce back in the second half, to me, banking as well as consumption for this year, I would say FMCG will do well, because FII money, when it comes back in the second half of the year, will tend to first go to safety and then only it will seek growth. So I would say that this year, and I would actually also pick IT pack for this year, because like I said, it's very thought process around that the valuation is corrected, but the business hasn't corrected, will mean that a certain amount of safety capital will flow in. So purely this year, I see you have to track where the capital is flowing. And I see the capital flowing to largely safety sectors from a foreign perspective. And it's better for this year than to just follow that foreigner. So essentially, IT, banking, and FMCG would be the ones delivering that high single digit return to the market this year. But if you take a longer term period, then I would obviously take it to consumer discretionary and to infrastructure and capital goods.
Fair enough. And as far as I understand, Sunil sir, so he's actually saying the larger banks, the good banks, again, which have managed well, and then we have the FMCG and the larger IT companies. Last question. And I want to ask you on the stocks because I know you won't talk about the stocks, but I want to ask you from a very top view institutional perspective. We know what has been in the media about the Adani Group and everything, like from and this is not even in the Indian headlines. It like a lot of my foreign friends actually they've been actually talking to me on that. So it's a thing which actually has grabbed a lot of institutional attention. As an
Mm.
institution, sitting with your long-term planning, long-term funds, very well thought out, well researched sort of investments, how you actually you look at this sort of headline, what is happening, and what basically has been your strategy so far?
So I would say that so this particular headline, right, naturally it affected that particular group company stocks, right? So I would say that I would put this down as three buckets. It hit that company's stocks, but within that group stocks, there are ongoing cash flow generating businesses, and there are others which are investing into high risk, infra future businesses, right? Two. And the third is an outside sector, like say banking sector, where the fear of exposure to this and what is going to happen came through. So the three things which got affected due to this news report, right? Now I would say that of those three things, two things were overdone. Which were the two? Within the group, those cash flow generating businesses got unnecessarily devalued because they are good quality businesses in existence for decades. Either the group bought into that or the group itself had a business which it did a great success of, right? So there it was overdone. The second aspect overdone was the banking. The correction in the banking for fear of the exposure to this group was overdone, especially in a period when the banking numbers were looking good and the overall scenario for banking is good. Still, that panic reaction meant. So, from my perspective, right, the first one, obviously, I didn't have exposure. The second one, I had a little bit exposure, but I would stay there. I would still wait to see what is going to happen in the market. But the third one, I looked as an opportunity to buy because I feel that reaction of the market was overdone and unconnected with the ground reality of what was the real exposure to those groups. And these were loans for their cash flow generating business. They were not like share-based loans or anything. So I think this was a good buying opportunity in that circumferential thing, which was a good thing for us.
Absolutely. So financing banks, I think, is perhaps which actually became the opportunity for this. Sunil sir, thanks a lot for actually patiently answering all our questions and giving a lot of education to our viewers.
Thank you, Piyush, and all the best to your viewers.
Thank you. And with that, dear viewers, hope you enjoyed this conversation. It's a wrap on this show.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.